What's up, future millionaires and current financial rebels? It's your favorite slightly cynical, always spilling the tea finance guru back with another masterclass. Today, we're talking about something that makes most people's palms sweat and portfolios bleed: economic recessions. Yeah, the R word. The one the news cycle loves to scream about, turning your grandma's 401k into a jump scare. But here's the dirty little secret the old school gatekeepers don't want you to know: recessions aren't just periods of loss. For the smart, the savvy, and the ones who actually understand how money moves, they are the single greatest wealth transfer events of our lifetime. While everyone else is crying into their overpriced oat milk lattes, clutching their rapidly diminishing stock values, a select few are quietly, strategically, and unapologetically getting richer. And guess what? You're about to join that club. This isn't about surviving a recession, it's about absolutely slaying it. Stick around, because by the end of this 11-minute deep dive, you'll have the playbook to turn market carnage into your personal gold rush. Let's get into it. Alright, first things first, let's talk vibes. Specifically, the bad vibes that kill most portfolios during a downturn. It's called panic, financial kryptonite. When the market starts to dip, and then dip some more, what do most people do? They panic sell. They see their green numbers turn red, their gains evaporate, and their lizard brain takes over, screaming, "Get out! Save yourself!" This, my friends, is the classic, buy high, sell low, the opposite of how you make money. Why does this happen? Simple. Humans are emotional creatures. We're wired to avoid loss, and the fear of losing even more money often outweighs the rational understanding that markets always recover. The news feeds into this. Every headline is designed to elicit a strong emotional response, usually fear, because fear sells clicks. So, you've got financial commentators hyperventilating about impending doom, your friends on TikTok are freaking out about their meme stocks, and suddenly, you're convinced the sky is falling. This is the herd mentality in full effect. Everyone's doing it, so it must be right, right? Wrong. The market doesn't care about your feelings, your anxieties, or your FOMO-induced decisions. It simply presents opportunities. When the herd stampedes for the exit, they often leave behind a treasure trove for those who dare to walk against the current. On the way up, FOMO drives buying at inflated prices. On the way down, FOLO, fear of losing out, drives selling at rock bottom. Smart investors. We do the opposite. We're not catching feelings, we're catching discounted assets. This isn't about being heartless, it's about being strategic. You have to learn to detach emotions from money. Your portfolio isn't a diary, it's a tool. Tools work best with logic, not panic. So, step 1 to profiting from a recession. Master your mind. Stay zen, even when charts give pure chaos. So, what is a recession, really? Beyond the scary headlines, it's not some mystical economic monster. Officially, it's typically defined as 2 consecutive quarters of negative GDP growth. For us, it means a temporary slowdown: people spend less, businesses might scale back, unemployment might tick up. But here's the perspective shift you need: recessions are also a natural, necessary part of the economic cycle. Think of it like a forest fire, devastating, yes. But after the fire, new growth emerges, often stronger and more resilient. Recessions are the economy's way of clearing out deadwood. Overleveraged companies, unsustainable models, speculative bubbles, all get flushed. This cleansing allows healthier, more innovative businesses to eventually thrive and lead the next growth cycle. History isn't just a subject you hated, it's your market cheat sheet. Every single recession, crash, downturn, whatever you call it, has always been followed by a recovery, and eventually, new all-time highs for the market. Always. From the Great Depression to the dot-com bust to the 2008 financial crisis and the recent COVID dip, the pattern holds. The market falls, yes. But then it climbs back, often faster than anyone expects, and generally goes much higher than its previous peak. The only people who truly lose in a recession are those who sell at the bottom and never get back in. For everyone else with a long-term mindset, a recession is a massive sale sign across the entire stock market. It's not a disaster, it's a huge, flashing green light for opportunity. This understanding is key to having that diamond hand mentality when everyone else is crumbling. Okay, enough with the philosophy. Let's get tactical. You can't profit from a recession if you're drowning in personal financial chaos. This isn't a spontaneous, by the dip, TikTok trend, it requires meticulous preparation. 1. Build your emergency fund, no excuses *** non-negotiable. 3 to 6 months, even 9 to 12 months, of living expenses stashed in a high-yield savings account. Not just for job loss, but for mental peace of mind to invest during a downturn without panicking. It's your financial shield and mental anchor. Without it, every market dip feels like a personal attack. With it, every dip feels like a shopping spree. 2. Decimate your high-interest debt ** credit card debt, personal loans, anything with an interest rate that makes you wince, attack it. When a recession hits, cash flow gets tight. You don't want to be paying 20% plus interest while trying to scoop discounted assets. High-interest debt is a wealth killer. Get rid of it, or have an aggressive plan to pay it down before things get spicy. 3. Cash is king, the dry powder strategy ***. Once your emergency fund is locked down and high-interest debt is shrinking, accumulate investment cash. Not for sitting around losing value to inflation, but for deploying when the market throws its temper tantrum. This is your dry powder. While everyone else is crying because they're fully invested in plummeting assets, you'll have capital ready to deploy strategically. How much? 10 to 20% of your investable assets in cash, patiently waiting for a 20 to 40% market drawdown, can turn years of mediocre gains into a single, massive leap. Don't be afraid to sit on cash during the good times. Patience. 4. Review and rebalance your portfolio ***. If you already have investments, audit them. Too concentrated? Holding speculative garbage? Diversification is risk management. Rebalance to avoid overexposure to risky assets. Consider adding defensive positions or stable dividend-paying stocks that weather storms. This isn't about selling everything, it's about pruning weak branches so strong ones can thrive. Okay, you've prepped like a pro. Your mind is right, your finances are tight, and your dry powder is locked and loaded. Now, how do we actually make bank when the market is bleeding? 1. Dollar cost averaging, DCA, the OG move ***, simplest, most effective for most people. Instead of trying to time the absolute bottom, you won't, commit to investing a fixed amount at regular intervals, regardless of market conditions. When prices are high, you buy fewer shares. When prices are low, like in a recession, your fixed amount buys more shares. This effectively lowers your average cost per share. During a recession, your DCA buys assets at a massive discount, setting you up for incredible returns when the market recovers. Consistency is key. 2. Identify quality companies on sale ***, the real shopping spree. The market is a massive mall. During a recession, everything is 50 to 70% off. Don't buy broken junk. Look for designer brands, high-quality items with temporarily slashed prices. What to look for companies with strong balance sheets, low debt, lots of cash, consistent profitability even in tough times, essential products or services, utilities, consumer staples, healthcare, robust tech infrastructure, and a history of paying dividends. Do your research. Don't just buy what's down the most. Understand the business. Is it genuinely undervalued due to market fear, or is its business model fundamentally broken? Buy great companies at amazing prices, not fair companies at bad prices, and definitely not bad companies at any price. Look at P/E ratios, debt to equity, cash flow, and management. These metrics get really attractive. 3. Strategic sector plays ***. Defensive sectors like utilities, XLU, consumer staples, XLP, and healthcare, XLV, hold up better during a recession. But long-term gains often come from buying beaten-down growth sectors at their lows. Tech stocks, XLK, consumer discretionary, XLY, and industrials can get hammered, making them prime targets for long-term investors. Imagine buying Apple or Microsoft at a 40% discount, knowing they'll rebound. Your dry powder makes a huge difference, allowing you to selectively pounce on severely discounted leaders. 4. Real estate and bonds, briefly ***. 4. Stability, government bonds, U.S. Treasuries, often act as a safe haven. While not primary profit generators, they preserve capital. For advanced investors, recessions create opportunities in real estate, distressed properties or REITs at discounts. This requires more capital and knowledge, making it secondary to stock market plays for most. The key message: when others sell in fear, you buy in logic. You are literally transferring wealth from the emotional to the rational. So, you've navigated the storm, bought the dip like a boss. Now what? Don't screw up the rebound. The biggest mistake after buying the dip is selling too early during the recovery. Here's the thing, the stock market is a forward-looking beast. It typically recovers before the economy does. Often, while unemployment is still high and news headlines are grim, the market will have already found its bottom and started its climb. If you wait for the official all clear, you'll miss significant gains. You need patience to hold positions. Remember why you bought those quality companies at a discount? For long-term growth. The recovery phase is where those discounted assets reflect their true value, and then some. This is where your wealth really compounds. Your job isn't done when the market turns green. It's done when your long-term financial goals are met. Maintain discipline, continue DCA, and resist taking profits too early. Let investments ride the next economic expansion. This is where your main character energy kicks in, reaping rewards of foresight and discipline while the world wonders how you got rich. Alright, fam, that's the playbook. Recessions aren't to be feared, they are to be understood, prepared for, and ultimately, profited from. While everyone else is bracing for impact, you'll be strategically positioning yourself for the next boom. It's not about being lucky, it's about being prepared, disciplined, and seeing opportunity where others see only despair. So, what's your move? Go audit your finances. Build that emergency fund. Shred that debt. Accumulate that dry powder. And most importantly, educate yourself. The more you know, the less you fear, and the more you earn. If this deep dive drops some serious knowledge bombs, smash that like button, subscribe for more financial truth bombs, and hit the notification bell so you don't miss out on your next wealth building opportunity. Share this with a friend who's still panicking. Let's get this bread. Peace.